next presenter is Michael Berman. Michael has decades of experience as a professional trader, hedge fund manager, and incubator of emerging traders. Michael has built a number of trading analytic platforms with 3 successful exits and has served as the CEO of a regulated CFD broker and as a director of a public company in his late 20s. Michael is an out-of-the-box thinker with a wide area of interest spanning economics, finance, technical and fundamental analysis, quantitative and behavioral finance, blockchain and cryptocurrency, philosophy, psychology, religion, and technology. You're a busy man.
What's that?
Exactly. Michael has a PhD in economics with a focus on behavioral finance. And his presentation today is The Problem with Backtesting is Not What You Thought. Please welcome Michael Berman.
Thanks. Oh, there we go. Hi, everybody. Is the microphone on? Yeah. Thanks very much to the Australian Technical Analyst Association for inviting me. It's a great honor. Thanks to Alan in particular. We almost did this, I think, when COVID struck, and then things happened. And Max, for your warm welcome. The last time I spoke to a Technical Analyst Association was in 2018. It was the CMT Annual Symposium in New York, and I just took a quick look at my topic there was called Myth Busting, Fact versus Fiction. And it's not the subject of my discussion today, but I thought I must just highlight, I'm probably the gloom agent in the room. I'm somebody who probably will upset some of the people, and I just feel it's my duty just to highlight how difficult trading is. You know, there's so much razzmatazz and sales around it, and it is damn hard. And in that myth busting, I had a very large database. I think I had one of the largest databases of retail traders. It was about 50,000, and I uncovered a lot of uncomfortable truths in that presentation. But anyway, for the subject today, backtesting is applicable to systematic traders. So I'm not so sure how many people over here are systematic traders, but if the biases that we're going to focus on in that discussion are applicable to systematic trading, then I think they're even more applicable to discretionary trading because there are so many biases. So subject for another discussion, but for discretionary traders, I'd highly recommend that you have a coach, keep a trading journal. Those are all really important things. And one last thing on that is make sure your assumptions are realistic. People get carried away with totally unrealistic assumptions. So anyway, coming back to the topic, so what is the problem? Why do we struggle to replicate the impressive results of our backtests in real-time trading? So according to the academic literature, they say 35 to 70% of backtests overestimate what will happen in real time. I would probably go closer to 90%. So people get it horribly wrong. And I cannot tell you how many people have approached me over the years and said, here's my backtest track record, give me $1 million to trade for you and that kind of stuff. And you don't want to be rude, but anyone who's been trading for some time will know that, I'm going to use strong language, it's garbage. If you think that you're likely to produce those kind of results that you've come presenting, and it kind of amazes me that you've got some funds out there that have raised millions of dollars on the back of a backtest. It's staggering where really high quality traders struggle to raise money, but I guess that's what sales does. So I break the problem down into 2 categories, one being psychological, and within that psychological category, I'd say there are two components there. There's one, let's call it your cognitive blind spots. It doesn't matter if you know that there's a bias, a potential bias there. You are prone to it, even if you know it, even if you don't know it. If you don't have the knowledge about certain things that are biases, you will encounter them. And then I'll save the deeper stuff till a little bit later in the presentation. Out of fear, you might think I'm a little bit on the edge, a bit of a whack job. And the second category I wanted to say is the industry. The industry is all about getting people to trade. That's how the industry makes money. It's based on volume, and every single broker wants to activate their clients to trade as much as possible, and the service providers, the vendors, the software vendors, and all that are all, I don't want to use the word cahoots, but let's use the word cahoots. They're in cahoots with them to try and enable the brokers to activate those traders and make money. I meant to say, Richard, great presentation beforehand. You're the most academic, non-academic I've ever met. And I'm not sure I can match your theatrics, but I'm not sure if your watch keeps the amount of steps you've done, but I'm going to try and stay put here. Also, we can see how it goes. I've never done this particular presentation before, so I don't know how long it's going to take. It could be over in a few minutes. We'll see how it goes. But also, if I'm going to touch on a complex subject, I'm going to try to keep it really simple, actually. But there might be things that you don't follow, and I'm open. Just hit me with a question, and it might enable everyone else to follow along if they're not following. So don't be shy. And also, the problem is actually not a trading or investment finance problem only. It's across the whole gamut of academic research. If you're a researcher, you want to get published, you fall in love with your thesis, your ego's attached to it. There's all these kind of things. Your job might be dependent on it. And there are a whole host of reasons why you will put research out there that is not replicable. So, I mean, it's of very limited value. But in many cases, people have good intentions, but it's just baked into the cake of the human psyche. Here are some problems that we've all encountered. No matter if you're a systematic trader or a non-systematic trader, everyone encounters these issues. Just go through a couple of them. What symbols should I include in my strategy? What time frame to use? Do I go daily, hourly, minute, or in some cases tick data? What look-back period should my moving average be? When should the start date be? What stop loss level to use, if you use a stop loss at all? And what take profit level to use, if at all? So I just remembered, I wanted to say something on the industry here as well, as one of the problems. Something I noticed, I've been trading a long time. I've been trading for 41 years. My bar mitzvah money when I was 13, I started trading. And in fact, my late father would definitely have been one of the guys sitting in the audience here. He's a doctor. He was the first guy to teach me about a trend line and all this kind of stuff. I thought it was hocus pocus, and then I got sucked in. In terms of the industry, I said one of the things that I noticed is if you've traded in the CFD space, the big thing in backtesting came this tick data. That was like the big breakthrough. And like I said, you got to do backtesting with tick data because then it's the most accurate and all that. But in my opinion, it's, unless you really are a short-term trader, that's your classic illusionist type of trick where you distract people from the main event and you make them focus all their energy. All you hear these guys talking about getting the best tick data, and it takes up hard drive after hard drive. it's not as important as many people think, and in fact, it gives you a false sense of security. So what is the solution to all of this? So my approach to this, it's a project I'm working on right now, is I believe you have to have a rigorous integrated scoring framework. So it's got to be integrated into your backtesting process. You cannot come after the fact and let's say, take your backtest and say, okay, I want to now see, let me try and do something to see if it's bias-free or that kind of stuff. You have to have an approach where you've built it into the whole backtesting framework. And I'll walk you through my approach. It's my belief, and I think it has value, and it's a work in progress. So just a little bit about me. I've been trading professionally for 25 years. And I've spent more than a decade incubating emerging traders. I think when we came across, was it through Rapper or Psyquation? Okay. I founded and exited a couple of fintechs, some better than others. If you're in the startup, you don't always get it right, but thankfully I've had a number of exits. And I think I've covered the full gamut. I've done long-term trading, macro, and more recently, we sold a high-frequency market-making crypto business to a Melbourne-based to a company called Zero Cap. So there I was trading where we're putting in maybe 4 or 5 orders a second. So I've gone from long-term to extremely short-term. I think I've seen a lot of it. And there was a theme in all the fintechs that I was involved in. It was around analytics. So in 2012, I started a company called Rapper, and it was an incubation platform for traders. Basically, it was about creating a score, a score that measured skill coefficient of score. It was a score that measured your skill in one number, and it's morphed into another company that still exists today. But it introduced me to a guy by the name of Marcus Lopez de Prada, and I'll talk you through why I think it's so important that I raise this name, because he's far smarter than I'll ever be, and he's one of the world's leading academics in the quantitative finance space. But he came up with an equation called the probabilistic PSR, probabilistic Sharpe ratio. We came across it in 2012 when we built Rapper, which stood for Risk and Profit Analyzer. We were a team of 3 PhDs, 2 mathematicians, 1 behavioral economist, and we were really sucked in by this particular score, this algorithm, and we built the Rapper score on the back of it. We did some fancy things on the. You'll be happy we didn't rely on Gaussian distributions. We did alpha stable distributions, which is a whole different world. Back in 2012, the computational requirements were quite immense. But Marcus, he's a professor at Cornell University, top 10 most read author in economics, dual PhDs, financial econometrics and mathematical finance. I don't know what an Erdos 2 and Einstein 4 is, but Erdos is a famous mathematician. It's how close his publishing is to Erdos. How close he is 2 and 4. So he's highly cited as an academic. I met him in New York when he was managing the Guggenheim Fund, which was like about 100 billion at the time, maybe not as much as that, but it was big. It was really big. And he's currently the global head of quantitative trading at the Abu Dhabi Sovereign Wealth Fund, which apparently is $1 trillion. And if you add, it's got its shadow bank side, it makes it $1.6 trillion, which would be the biggest sovereign wealth fund in the world. So Marcus is a heavyweight, and why I'm going on about Marcus is I'm just borrowing from him. not the guy who came up with these formulas, but I think they're rock solid foundations to build on. So basically, I've created a scoring framework which rests on the foundations of these particular different areas of research. Marcus does a lot of work with David Bailey, who's a professor at Harvard, and they've really gone into backtesting and analyzed it. At the end of the talk, I've got the papers that you can all get off the internet for free and read them in greater depth. But we're going to cover, these are the components that are built around the score. A deflated Sharpe ratio, we'll explain what that means. A probabilistic Sharpe ratio, which I touched on, that was in 2012, which was like the first building block for me into this area. Probability backtest overfitting. I don't know how to say the word C as CV. It'll come up in the slide and then I'll quote from it, but I'm going to stuff up the pronunciation, so I won't try and act smart. And there's a component that looks at in-sample and out-sample data, regime stability, and then I'm very big into having one score. It makes it easier to deal with, much harder to capture everything in one score. But I think it's worth making the effort because people, once again, will use all their biases. If you're strong on one thing, weak on another, you'll focus on the stuff that you're strong at, and you'll kind of ignore the stuff that you're weak. When you've combined it into one score, but let's say, you've been clever with the weightings, it can be very powerful. So don't panic. This is the first. We'll let Richard talk us through this. Okay. So the thing you need to know, we're just going to focus on the words, not on the notation, but it computes the probability that the Sharpe ratio is statistically significant. And what it's doing is it's controlling for multiple tests and data dredging and all those kind of things. And, oops, wrong button. So just as a refresher, the Sharpe ratio, which is still, with all its shortcomings, is still the gold standard that the industry uses for measuring risk-adjusted returns, and you can knock it, but, and I've done extensive work on this particular, it captures, let's say, my research is maybe a little bit out of date, but I'd say it captures 95% of what everything else, even the other good ones, do. So it speaks a lot. So focus on the Sharpe ratio, its mean of returns and standard deviations. Those are the two things that it incorporates. But now with the deflated Sharpe ratio, so we want to penalize that particular Sharpe ratio for the non-normality of the returns there. Richard, I'm talking your language, I think. Partially, I'm only partially talking, but it speaks to the fat tails, so it will penalize fat tails. It rewards length of track record. My philosophy has always been with allocating money is minimum of 2 years track record. And I think I'm being quite generous. Like people with 1 month, 6 months, they think they are King Kong because they've, caught something and shot the lights out. But you can just see as track record goes further and further, the amount of people that actually perform decently just drops off a cliff. So it's useful. And then the number of independent trials is built into that equation. Here's the probabilistic Sharpe ratio. So it's actually very similar. The DSR and PSR are very similar, but they're not the same. And I just did a slide. You can see it. Okay. So I'll just in a nutshell summarize. The PSR asks, is the Sharpe ratio statistically significant? I didn't. This is actually important. What the PSR does is you set a benchmark for the Sharpe ratio. In the testing I'm going to walk you through, I've used a Sharpe of 0.5. Just so if some of you aren't familiar with Sharpe ratios, like a Sharpe ratio of 1 is really decent, especially if you've got a long track record. It's pretty excellent. So you want to know what is the probability that you're going to beat that benchmark. That's what the PSR is all about. And so PSR asks, is the Sharpe ratio statistically significant? And by that it means how probable is it that it's going to beat the benchmark? And the DSR is the Sharpe still significant after accounting for how many ways I could have fooled myself? So pretty powerful. Then, yeah, there's this test we do in this. By the way, I'm going to jump through this. I'm going to get going to the actual meat and potatoes where you can actually see what I'm talking about very shortly. But in terms of probability of backtest overfitting, here's that word that I couldn't pronounce, combinatorially symmetric cross-validation. So that's the method used, which Bailey, he built on. It's research that has been around for a couple of decades, but he actually built a better process around that. And we won't go into too much detail there. This is a simple, your in-sample data over your out-of-sample data, and coming up with a decay ratio. So anything close to decay close to 0 is stable. Large negative is your performance collapses. And regime stability. One thing I've noticed over the years is, if anyone can figure out how to identify in real time what regime you're in, you're going to make a lot of money, because it's bloody very easy after the fact. But when you're in the fight, it's very hard to identify. But a good strategy is able to survive through multiple regimes, and the good strategies are ones that play to their strengths. So when you're in a trending regime, you jump on that wave and you stay on that wave. Those are your guardrails. That's going to help you survive. And which is very much actually the subject of this talk, is the selection bias detection. I'm not going to go into the components. This is a work in progress. It's quite powerful, and you'll see it in one of the examples that I'll show you. But and then I put it all together into a score. That's my bread and butter type of approach. Just keep things really simple. One score, and you should know if it's good or bad. Just one thing I just wanted to touch on, which Richard spoke about in the previous talk, and I personally think the markets are largely random, but they're not completely random. So funny, big wave surfing is probably your closest thing to an edge in the market. That's from my research and expertise. And I would just say one thing is that there are inefficiencies in the market, and I would just say they're at the margin. So one should not get overly excited when you think you've stumbled upon a holy grail. I'm just talking generally. I just wanted to make that comment earlier on. It's at the margin. So if you've got a good process, you can harvest that small margin and you can turn it into something big. But they're not like giant, wide anomalies. So okay, so I'm gonna walk you through my process here. So I'm trying to keep things really basic. I'm only focusing on 3 particular variables in this. This is I call it a longish trend following system. It's using a moving average. Simple, exponential, doesn't matter. It's just a moving average. In this case, it's simple. And I'm going to tweak through 3 variables over the process of I'm going to look at the period, the moving average period. So we'll change it from 200 to something. We'll play with the emergency stop loss, which is something that I keep on top of the whole portfolio, not on the individual stocks. And I failed to mention there are 23 symbols that we're using in this particular strategy. The results and all the different bits and pieces in here is not really that important. It's just I'm using this to kind of just show you how this thing works together. Shout out to Richard's Norgate data. Everything's driven by, I've worked your data backwards, forwards, all upwards and downwards. It's great data, thank you. And I'm using, what do I use? Just for illustration purposes, I'm using 23 world indexes, world stock indexes. Not really that important. It could be anything. It could be stocks, could be futures, could be, I just thought it's nice and uniform and it might help me explain this quite nicely. So here's a 200-day moving average, equally weighted. So if there's $1 million, we divide the $1 million by the 23 symbols, and you can see there that we rebalance every quarter. Yeah, that's all you would probably need to know on that particular side. And it's nothing too fantastic. What is the annual return is, call it 2%, Sharpe of 0.3. It's 25 years worth of data. So it's okay. So here I go through 6 variations of testing. So the first one I had was 200-day moving average, 30% emergency stop loss. That was my base configuration. It's just something you hear about the 200 moving day average. So that's where I started. And then I just played around with some variations. So I dropped it from 200 to 150, kept everything else the same. I went to 250. I then went to 400-day moving average, kept everything the same, and then I went back to 200-day, then I went and changed the emergency stop loss. I did 6 variations. So what the framework that I've built is that every single time I do a back test, it's captured into a database, and it's not forgotten or put away in a shelf that you're never going to look at because you're embarrassed by it, because this is the process of research, and you need to, that's part of your discovery. So here you can see those 6 tests come through here, and they that penalty comes through here. So here's your DSR, that fancy calculation. We won't go into all the bits and pieces here, but the important thing is look at the top right slide. That is your Sharpe ratio before it's corrected, and there is your deflated Sharpe ratio. So we were penalized by 21%. That's what the DSR was doing. It's looking at the non-normality of your distributions. You can see this kurtosis here. It's not halitosis, it's kurtosis. It's very high, meaning that there's fat tails. So bad things happen with fat tails. Here's your PSR. Once again, you can see over here, I put a threshold of 0.5. So the Sharpe ratio we target in is 0.5, very modest, nothing to write home about. Maybe, actually, I would write home if it was robust. The Sharpe of 0.5 is not to be sneezed at. But the bottom line, which we're all interested in, your current PSR is 0, very low. So it's saying you've got 0 chance of hitting your threshold. That's what, from a robustness point of view, and very powerful because we know 0.5 is where we're going for, and we're not going to get there. And there's, I suppose, one extra point I'd mention over here in terms of the sample size, just so you know, there's 6,489 days in the sample size. You can add more days. It's going to add no impact on your PSR. Like, that's a good sample size. So PSR is happy. Marcus is happy with 6,000. Here we go to PBO, and this is the probability of backtesting overfitting. We'll just zoom in onto the main point here. It's because that will get raised in another slide. The PBO, yeah, there's a 65% probability that you've overfit your data. That's what it's saying. And over there, that is your rolling window of Sharpe ratio, trying to measure the stability through the various regimes, and that's what it does. And then we look at in-sample, out-of-sample. So what you would want to see, obviously, is that your out-of-sample over here would at least be positive, but it's negative. So it's a rule of thumb. I noticed Richard had a bigger out-of-sample. Like the classic rule of thumb is 70% in-sample, 30% out-of-sample, but I'd actually, and especially with Norgate data, you got long time series. Like for this kind of stuff, maybe not for some of the smaller world indexes, but you could go 40, 50 years. So I would be inclined to maybe balance it out, maybe have 50% in sample, 50% out of sample. That would be really robust and help. And you put all of that together. Here's my rating system based on your score: gold, silver, bronze. In this case, it was a bronze with a 52 score. So marginal performance with high overfitting risk requires extensive monitoring before live trading. DSR is pretty weak. So that's that. But one of the things that I've built into this, which I'm quite proud of, I don't think I've seen it anywhere else, and I think it's kind of cool, is that sometimes you get lucky that you choose a configuration setup. Let's just say it was when we did those, when I showed you those 6 variations, the 6th one was the best one. Let's just say your first test was the 6th one. So you reverse the order. So that was the best. So you got no penalty there because you haven't done any further testing. But to know that it's the best, you've got to go do some testing down the line. So what happens, what I've made the system do is that it will overwrite the database. As you keep doing more and more testing, whatever you've done, doesn't matter if you were first, second, or third, it brings that deflated Sharpe ratio, that penalty factor, gets rewritten over all the data and keeps it fresh, so that it knows you know that even if you are doing a little bit of curve fitting, you've been penalized at least. So here's your classic selection bias, which is cherry picking, and we all do it, every single one of us. So if you go to look, that first example where I showed you that we did 23 backtests, if you look at the individual ones, which I've put in a column there, you can see a couple do really well. I should have marked them, but what I now do is, okay, so I've seen this. It wasn't so great as a portfolio, but there are 3 there that I like because they did really well. And I go choose those 3 and I run the back test again. And now I've got a strategy that is making a 5% annual return. Sharpe ratio is shot up to 0.58. And now I think I'm on my way. This is a great strategy. So without going into all the details again, here you can see it's saying 7 tests, even though I actually did this the other way around, it picked up. But you can see there's a 22% penalty here because we're doing more testing. Which is very interesting here is the PSR. It likes it. It's at 1. It's saying that basically there's a 100% probability you're going to beat your 50%, your 0.5 Sharpe ratio threshold. So it's a thumbs up over there. You can see this is positive. So your out of sample data is positive. Your decay ratio is positive. So it's getting duped into some good results here. There's actually positive skew. Is there positive skew? I think there is. There's positive skew on, there's more, in the daily returns, there's more winners than there are losers. There's only a 51% probability that you've overfitted it. So bottom line is it actually failed. I think I might have not put, it might be missing one slide that I added, which is actually a really important slide. But it might come up somewhere down the line. But the bottom line is, the performance metrics failed to catch the cherry picking, but there is one component called the selection bias, which is made up, I showed in an earlier slide, made up of 5 factors, and it picked up the max bias detected. So it's no one score or metric is going to do all the work and see through it. It would probably see through one of those equity curves. The PSR would penalize you for an equity curve that is very smooth. It's smart to that, but in this case we still caught it. The score is 52.3, also still in the bronze range. So what I'm highlighting here is that I believe you need something on top of your back testing that is not forgetting all your trials and is pointing you in the direction of where your biases are shining. Geez, Richard, you're getting big publicity here, but Norgate all the way. So one of the few data vendors that actually tackle this particular subject is Norgate, and one of the things is everyone throws this term around like survivorship bias and all this. I've got a survivorship bias-free database and all this kind of. What does it actually mean? I think less people know what it actually means than who say they do. But let's just walk gently into this particular area. One of the things I didn't quite realize is I've chosen the S&P 500. What I've done is the data in the Norgate stack, you can actually see each month going back long time, many decades. You can see which symbols which were in the index, which constituted the index. So the current index has 656 constituents. I bet you most people didn't realize the S&P. Is that right? I mean, I double checked that the S&P 500 has more than 500 stocks in its index.
Yeah, it's got 505.
Okay.
Anyway.
It's going to upset the next few slides there, okay. But there might be a good reason for that. There are 536 that have survived over the last 19 years, and 37% have dropped out. So because we're under advisement now on the number of stocks in the index, I'll jump through this slide. But basically, it's saying that the longer you don't account for the bias, the bigger it gets, which kind of makes sense. Yes. There could be a bug in my code when I was scraping. Wouldn't be the first time.
Software always has bugs, you just
Yes.
don't know where they are. So,
Yeah.
just in terms of survivorship bias, I think a really interesting metric is one that I know off the top of my head is the Russell 3000 in the US. It's that rebalance every year, but it's roughly the top 3,000 stocks. Since 1990, there have been over 12,000 separate securities in that index.
Wow.
So it goes to show that
It moves around a bit.
a massive amount of survivorship bias. There's 9,000 that have disappeared for some reason,
Yes.
either due to delistings or being taken over, perhaps, or bankruptcies, or they've just dropped out because of their market cap.
Yeah, doesn't surprise me. This slide might just help you understand what does it mean to do a backtesting system. Let's just say you invest in the S&P 500 constituents, and so that's your universe. If you go back, what did I do? So what you have to do if you want to do this properly is you can't look at what's in the index today. You have to go back to the beginning, which is, in this case, it's January 2000, and you've got to look at what were the index constituents then, and then if you rebalance so a monthly rebalance, and if your system rebalances every month, it means you have to loop through every single month and look at what were the index constituencies in that month and apply your system to that. It's work. I mean, thankfully, computers make that work actually quite easy, but most people take the shortcut. They just apply what the index is today, the constituents today. And I'll highlight it in a classic example here. Let's just say you trade in a momentum strategy, and your universe that you're looking at is the S&P 500. So back in 2000 and what are we looking at here? Tesla. Okay, so your system, because you're using the current index at the moment, that's what you're working with. So you go back and you run your screener, your momentum screener through the current index, and there's a buy order. I made it up that it's a buy order at that particular point, and you go buy Tesla, and you ride this incredible wave, and you think you're a genius. But the truth of the matter is, Tesla was only included in December 2020 into the index. So you've lied to yourself. You wouldn't have traded it. But your backtest now shows this beautiful, and especially if you cherry picked it, you now have killed, you've killed everyone. You're the best in the world. Another way of looking at it is in the reverse, is take Lehman Brothers. So once again, you're only looking at the index today, and you go back. There was no Lehman Brothers according to your current index. But if you go back at that particular point in 2008, it was in the S&P 500, and the chances are, this is hypothetical, let's say you were a mean revert trader, it was dropping, you were buying and accumulating Lehman Brothers. So you would have been killed by that particular bankruptcy, but it doesn't show up in your data. So it's another great example of how survivorship bias really impacts your performance, and hence it's worth doing the work. You've got a massive database. Norgate's got a great database of all those ones that have survived and the ones that didn't survive as well. Yeah, just some best practices going forward. My advice is predefine everything before you start your testing. So have in mind, what is your universe? What are you looking to trade? Have that all in mind up front. Time frame, parameters, all those kind of things. Use survivorship-free data. There's always a price attached to free. Yahoo Finance is not your solution, I don't think. I don't believe. And they're making it anyone who codes and tries to pull free data, I don't know. It seems like impossible it's very unreliable, the API to getting Yahoo Finance data anyway. Test complete universe. Don't cherry pick, and hopefully if you cherry pick in, my bias detector will pick it up. Record all results, good and bad. So if you don't use a fancy database system, just keep a record of all your back tests. But I know the way the human mind works is that you probably will do something with it. You'll lose those back tests that didn't make you feel so good. Apply multiple test corrections, so that's DSR. You can apply the formula for yourself. Walk forward validation, multiple out of sample tests. Check for regime stability. I didn't deal with it in today's talk, but cost sensitivity is huge. Everyone says, no, trading today is so dirt cheap and all that kind of stuff. Depends how often you trade, and it's not just the commission. There are costs to trading, and they add up. Even in this particular, I didn't isolate it. This is a 25-year trading at 200 moving day average. The costs were quite, I think there were 2,000 odd trades. The costs add up. They're a big drag. Don't fool yourself when you say I've tested hundreds of variations and I've got it perfect. I won't mention the name of it, but there was a software. It's not as popular now, but it was one of the first that came. I remember this maybe less than 10 years ago. They were speaking about genetic algorithms. That was their big selling feature. And they said, you just sit back for 10 or 15 hours and it will come up with hundreds of different trading strategies. It's looking at millions of variations, and my gosh, this thing sold like you cannot believe. People, and everyone was telling me, look I've left it for 2 days. I've done 20 million back tests, and I've chosen 100, and we're going to kill it now. And it killed them. Yeah, so this one symbol works great, so that's kind of like my cherry pick in there. Using current index constituents for historical tests, that's the survivorship bias, those are red flags. When there's no out of sample testing, and also results too good to be true. Sharp ratios of 2+ are rare, and the amount of retail traders that show you a sharp of 2, it's that. Not to say it can't be done, but it can be done for a short period of time. Like, yeah, you started trading, I don't know, after the Trump, what is it called, in April, when it swooned, and then it just kind of went up for the next 6 months. Like if you just started trading there, yeah, your Sharpe ratio, if you annualize it, it's probably 4 or 5. Don't think that's how you will normally trade. That's a telltale sign. In fact, I'd go as far as saying if your back test shows you more than 2, you've probably made a mistake in your back testing, and I wouldn't rely on it. And now, just I see we've got 12 minutes. I can share a story before I jump into this. So, started trading professionally in 2001. I was in South Africa at the time, and I'd read the book The Market Wizards, and I was totally like, this is my future and all this kind of stuff, and I really loved it. And I noticed there was a Dr. Van Tharp in there. So it was the first time I got exposure to a trading psychologist. Like, what is a trading psychologist? Never heard of such a thing. Anyway, I phoned up the Psychology Association in South Africa at the time. This is 2002, maybe 2003. And I said, I'm looking for a trading psychologist. So they said to me, what? What is that? So I kind of tried to explain what I'm trying to do. And they put me in touch with a guy. I phoned him up and I asked him, would you be my coach? So he says, no. I don't have any idea what that is, but I've got the guy for you. he put me in touch with a guy who's Dr. Paul. His real name, he was a sexologist on the radio, like Dr. Ruth. His name's Wolf Solomon, and so I went to a sexologist for trading coaching, and moving along. That's when I got, let's say, my first real exposure to Freudian type of psychology, and then over the years I delved into different, let's say, schools of thought, and in about 2006 I became hooked on Jungian psychology, Jungian analysis, and that's been like my go-to ever since. And Jung speaks in very flowery language, and in terms of like these motifs of symbols and all that kind of stuff. And that's why I thought, let me warm you guys up with a little bit of numbers and statistics before going into this type of thing. But I think the biases are a lot bigger than just cognitive psychological things. These are much bigger powers that have symbolic powers that go through the century, the millennia. So we're all driven by this archetype of the hero. It's like a primordial drive to be extraordinary, to be somebody special. We all want that, and part of the whole process of growth in psychology, Jungian psychology, is wholeness, and that's like getting in touch with your inferior, your faults, your nastiness, all the things that you're embarrassed about, and it's confronting those. But your ego doesn't like that. So the ego wants to kind of not go there, and it represses that truth. So you're fighting that battle against your ego. It doesn't want to see the truths that you are kind of aware of, but not really aware. And once again, the shadow of greed and magical thinking, it's not stupidity, it's a psychic compensation for vulnerability. We inherently, all of us have an element of greed within us. We all want to make money and all this kind of stuff, and we think it's owed to us. When you trade in, you feel like, I'm going to be rich from this trade. It needs to, I deserve it. And that creates this kind of magical thinking where you think, I'm special. And the myth of defeating the odds, there Jung speaks about ego inflation, where you like tapping into this divine child. You think I'm special. Once again, I'm special, and I'm going to beat the odds. The odds apply to you, and you, but not to me. And we all fall for that. And why it overpowers rationality? That's because backtesting is dealing with cognitive biases are dealing with, no, I'm going to mess that up. I actually wrote it down. Let me see what I wrote here. Reason speaks in statistics, unconscious speaks in symbols. We have to bring these archetypal charges into our consciousness and see that the system is a desire for our immortality. So I'm getting a little bit woo-woo, and all that kind of stuff. But what I'm really saying is that we are driven by these generational powers, these forces that sometimes we don't have control over them. And therefore, once again, to reinforce what I'm saying is you have to build a framework around you to guard you. And it doesn't have to be this elaborate system that I'm speaking about here. I know Cam said earlier in a talk, he said, by the end of today, you should have a mate that you should be talking to. So just even if it's one person that you just shared your progress of the day or something like that, it's easier to spot a fault in someone else than it is in yourself. So definitely, because we're all perfect in our own minds. But anyway, that's it. I think that's it. Here's these references. I don't know if you're going to be circulating these, okay. So here are the references that I used to build this framework, and here's my details. It's all free. I write a daily global macro newsletter, and I try to throw a little bit of wit into it, self-deprecating humor, and I talk big themes, more discretionary, but everything's based. You'll see if you follow me, you'll see that I try and base everything in numbers because it's so easy to lie to ourselves. Thanks. Any questions?
Thank you very much. I do quite a lot of backtesting. I have but it's in futures markets. Mm-hmm. So I don't think I can really have selection bias there because wheat is traded for 40 or 50 years or a lot longer. Right?
Is that all you trade, wheat?
No, I trade commodities, Forex, and interest rate futures.
Yes.
Okay, so I'm not got, as far as I can see, a bias. I'm using back-adjusted data. But there's one thing I do that my programmer really criticizes me on. If there is a commodity that doesn't trend, basically corn is an example on my system, I don't trade corn. So it is... Should I include the corn in my sample, or should I? How much is this a problem?
Well, you chose not to include corn after you saw, let's say, looking back at history, that it didn't trend.
Yeah.
And it could become, tomorrow could be the biggest trend in corn. So you've used history, hindsight to look back. I mean, if you're going to trade, look, I don't know how many symbols are in you. You've probably got enough diversification, but there is a form of bias in what you've just said.
Yeah, that's what I was thinking.
Yeah, but I would argue that there's lots of bias in deep into your system as well. In terms of, I don't know if you're using RS, whatever you're using to trigger your buy and sell signals, the parameters you're using around there. How did you choose those? You probably went through a series of testing.
Yep, yes, exactly.
And losing money and all that kind of that as well. But yes, so there is a form of, it's hard to comment from afar, but without looking at, but the chances are there's some bias.
There's a lot of bias there. You should be aware of your bias, but I mean, you are testing.
Yes.
You've got to be biased. I mean,
yeah, it's just...
If it fails, why would you trade it?
Because in the scheme of the whole thing, you're dealing with unknowns, so it needs to be factored into your probability of success, because all you're doing then is you're just throwing out as if they never existed. In the real world, things unfold in a very uncertain way. And you see, Richard, I'm using your term there, uncertain, not in a random, I'm being careful. Yeah. Yes.
10 years, 15 years.
No, that is an interesting, because cocoa.
If
you
shot.
Find this anecdote.
Yeah.
Cocoa virtually doesn't trend. I didn't trade cocoa.
Yeah.
Because it was really a bad one, and then I subscribed to a slightly bonkers American futures broker who does weather.
Yeah.
And he forecast a big weather event over the cocoa growing region in Africa. So when my system went long on cocoa, I took a position.
Yeah, and it went parabolic.
It went parabolic.
Yeah,
so
it was
I
amazing.
suppose there I'm contradicting myself about 5 times. But the end was happy.
Yeah.
So okay.
I think my message is you need to be general. You've got to generalize, because we're picking these anecdotal stories, and we all latch onto them, because now I'm thinking, who's this weatherman? That's just how your mind and he might have got lucky. Who knows?
Well, I think he did get lucky,
Yeah.
but I'm still reading him every week.
Okay.
Keith, you're going to have to cut it. Haven't got time. Actually, you're going to be hanging around, are you?
Yes, I'm
So you
around.
can talk.
Sure. Thanks, everyone. Thank you. Thanks.
Don't go too far, Michael. I'm going to refer back to Richard's presentation before. You were talking about hunting for outliers. And I think in this room there are multiple outliers. And what I mean by that is what Malcolm Gladwell talked about as outliers in his book, The Outliers. When he talked about that to get good at something, you have to put in at least 10,000, that the researcher said at least 10,000 hours. The fact is, whether you're a systems trader, discretionary trader, whatever thing you trade, you only get really good at this with practice. Because he actually said in his book was practice isn't the thing you do once you're good, it's the thing you do that makes you good. And as you can see from the presentations we've seen from everybody so far, they know they're experts in what they do and they just practice what they know, or they preach what they practice and they know works. So thank you very much, Michael.